Hi, good morning. Today's session is risk analysis in capital budgeting. A risk is basically known as the possibility of variation between actual return and expected return from the investment. Or in other words, variability that is likely to occur in the future return from the investment. That's known as risk. It's also known as the possibility of incurring loss in any investment is known as risk. You can measure the risk, you can quantify the risk, you can evaluate the risk. So let's look into the reasons for the events that influencing the investment forecast. The first one is general economic conditions. If it is boom period or recession period, it will influence on the investment forecast. Then industry-wide factors. A particular sector is going to affected by a lot of things that's declared by the government. That's known as industry factors. Then company factors. That company specific related issues will influence on the investment forecast. So these are the three things affect on the investment forecast. Let's look into the types of or techniques of risk analysis. The first one is probability. Second one is variance or standard deviation. And third one is coefficient of variation. This is one of the statistical technique for risk analysis. Then conventional techniques are of different types: risk adjusted discount rate and certainty equivalent. As you all know that the first concept, probability. Probability is described as a person's opinion about the chance of that event will occur. That's known as probability. Say for example, a forecaster should not give just one estimate. He will give a range of associated probability. A probability distribution will be given. That's the way you can calculate the cash flows from the probability assignment. A typical forecast is usually a single figure for a period, but in the probability concept it won't be like this. Best estimate, most likely forecast, it will be given. Okay, the chance of happening that event will be also given. Then you can work out that. So how we can calculate this expected net present value from the probability assignment? Once the probability has been given and future cash flows are given, then the expected cash flows in probability is known as expected total cash flows. Hi, good morning. Today's session is risk analysis in capital budgeting. As you all know that risk is known as the possibility of variation between actual return and expected return of the investment. In other words, risk is known as the probability of incurring loss in any investment. That is also known as risk. Risk is also known as the variability that is likely to occur in the future return of the investment. It is also known as risk. So risk is viewed from different angles. Why this risk occurs? It always comes as a villain in the organization or in the investment due to three reasons. It's general economic conditions. Sometimes the recession period may affect on the economy, which will affect on the investment forecast. Then industry-wide factors, industrial policies, then life cycle of the industry, which has a lot of influence on the investment forecast. Then company-specific factors, the company's management policies, then some other company-wide related issues, All these will influence on the investment forecast. Let's look into the techniques for risk analysis. Just like the NPV, IRR, all these techniques, you can use some techniques for risk analysis in capital budgeting. Let's look into that. Probability, variance of standard deviation, coefficient of variation. These are the statistical techniques for risk analysis. Then two conventional techniques are there. The first one is risk adjusted discount rate and second one is certainty equivalent. The first concept is known as probability. Probability is basically known as the chance of happening an event in the future. That is known as probability. So it's very difficult to get a single figure for a period. Under this circumstance, we will put the options like best estimate, most likely forecast, and the chance of happening that event will be assigned there. That is known as probability. So probability is not just one estimate, it's a range of associated probabilities. Using this probability concept, you can calculate the expected net present value. How we will calculate that? Expected net present value is sum of present value of expected net cash flows. So how you calculate the expected net cash flows? It is nothing but the probability into cash flow, that is known as expected net cash flows. Then you will calculate the present value of the expected net cash flows. So this is the formula. Net cash flow into probability is known as expected net present value of the cash flows. Then variance of standard deviation. You know that it's the deviation between, standard deviation is known as the deviation between the expected cash flows and actual cash flows of the project. You will calculate the difference between expected cash flow and actual cash flow of the project, which is known as variance. So standard deviation is known as the square root of that variance, that is known as standard deviation. It is also one of the absolute measure of risk for capital budgeting technique. And third one, coefficient of variation. Finally, you can calculate the coefficient of variation to measure the risk of the investment. So there is a formula for that. Expected value divided by standard deviation. So now you've got two things, expected net present value of the project and standard deviation of the project. And expected value divided by standard deviation tells about the coefficient of variation. So this is the way in which you can calculate the risk of the investment. Let's look into the problem. A project has cash outlay of rupees 6 lakh. It is expected to generate the following cash inflows with probability in next 3 years. So 3 periods are given. Let's look into that. Cash flow after tax and probability for first period. Second period, cash flow after tax and probability. Third period, cash flow after tax and probability. So this will be given and you want to measure the risk of the investment. So what you want to do first? First step number 1 is known as this cash flows and this probability is given. You are multiplying the cash flows with probability and you will get this 35,000, 2 lakh into 0.2, 40,000, 4 lakh into 0.3, 1 lakh 20,000, 3 lakh into 0.4, 1 lakh 20,000. Likewise, you can calculate it for the second period. 3 lakh into 0.3, 90,000. 2 lakh 75,000 into 0.2. Likewise, you make the calculation by way of multiplying the cash flow with probability for 3 periods. And you are getting the mean cash flows. That means the sum of this that you calculate, sum of this is known as 3,15,000 mean cash flow for first period. And second period also mean cash flow for the second period. And third period also you calculate the mean cash flows. Then what you want to calculate, again the present value is given in the question. Present value at 5%, that's the question, the factor given. So at 5%, you will calculate the present value of cash flows for first year, that's 0.952, first period, second period, and third period. That is first year, second year, and third year. First year 0.952 is the PVF at 5% for 1 year. So you take that and you multiply with the mean cash flows. You will get the present value. And second period also 0.907, multiply it, you will get the present value of cash flows. And third period also you can calculate like this and you multiply it with the mean cash flows, you will get PV, present value. You find the sum of this, that is present value of cash inflows. Then in the question it is given what is the cash outflow. Cash outflow is 6 lakh rupees. And what is the formula for expected NPV? Present value of cash inflows minus cash outflows, 7,92,550 minus 6 lakh. So expected NPV is 1,92,550. So this is the first method that used to calculate the risk measurement, expected NPV of the project. Then you want to calculate standard deviation, then the coefficient of variation. So next session we will continue this. Thank you.